Imagine this, a 15% annual yield hitting your account every single month. Not a paycheck, a dividend. From a brand new ETF modeled after Warren Buffett's portfolio. It's called OMA, and investors are already calling it a game changer. But here's the million-dollar question. Is this the holy grail of income investing? Or just another shiny trap dressed in Buffett's name? Today, we're diving into the Omaha Shares Berkshire Select Income ETF, ticker symbol OMA. It's built around Warren Buffett's top holdings, but with a twist. This ETF is designed to generate a massive 15% annual dividend paid monthly. That's over $1,250 a month from just a $100,000 investment. Sounds amazing, right? But high income always comes at a price. So in this video, we're answering three big questions. Is the 15% yield actually real? What's the hidden cost of all that cash flow? And most importantly, should you invest in it? Stick around, because by the end, you'll have a clear answer. So here's the scoop. Warren Buffett's company, Berkshire Hathaway, ticker symbol BRK.B, is legendary. It's delivered an average 19.8% annual return for 58 straight years. Yes, you heard that right. Nearly 20% a year for almost 6 decades. But here's the problem. Berkshire doesn't pay dividends. Buffett prefers to reinvest every dollar into long-term growth. Great if you're building wealth. Not so great if you're trying to live off income. That's where OMA comes in. Think of it as the income hacker's version of Buffett's portfolio. It takes Berkshire's top stock holdings, Apple, Coca-Cola, American Express, and layers on a covered call strategy. In simple terms, it rents out the upside of those stocks in exchange for cash flow every single month. The result? A target yield of 15% per year. That's $1,250 a month on a $100,000 investment, even if the market doesn't move. Now, here's something to note. Despite the fund's name, only 10.36% of OMA is actually invested in BRK.B. The rest is made up of 20 high-quality stocks Buffett owns, plus a few extras. It's not a trick. I think those extra holdings are necessary to make the income engine through covered call strategy work. Bottom line, OMA isn't just copying Buffett. It's rebuilding his strategy for income-focused investors. And for someone like you, who's craving reliable cash flow from Buffett-style businesses, this might be one of the most interesting ETFs to launch this year. Now let's talk about why OMA stands out in the crowded ETF landscape. First, it targets a massive 15% annual yield, paid monthly, not quarterly like most ETFs. That means consistent cash flow you can actually use for real-life expenses. Second, it holds a basket of high-quality U.S. companies, names like Apple, American Express, Kroger, VeriSign, and Bank of America. These aren't speculative plays. They're stable, cash-generating giants. And third, you don't need to mess with options yourself. OMA's team handles the complex, data-driven covered call strategies behind the scenes. You just collect the income. But here's the thing. Alpha doesn't chase yield blindly. So before we call this a passive income powerhouse, let's flip the coin. Because with every high yield, there's always a trade-off. So far, OMA sounds like a dream. Buffett-backed businesses with a 15% monthly yield? But let's pump the brakes. This kind of income comes with real trade-offs, and that's why OMA probably shouldn't be the only ETF in your portfolio. First up, diversification. While ETFs like SCHD or VTI hold hundreds, even thousands of stocks, OMA holds just 20. That's tight. These are solid names, sure, but with a portfolio that small, one bad quarter from Apple or Chevron could shake the whole fund. Compare that to something like JEPQ or QQM, which spread risk across way more sectors and companies. Next, the cost. OMA charges a 0.95% expense ratio. That's $95 a year on every $10,000 you invest. Not terrible, but not cheap, especially when QQM charges just 0.15%. So yeah, the fees will eat into your returns over time. But the biggest drawback? The upside. OMA uses covered calls to generate income. Great when the markets are flat or choppy, but during a bull run, you're capping your gains. Say Apple jumps 20% on a product launch. A triple QM investor might enjoy the full ride. But with OMA, most of that upside is sold off in options contracts. It's the classic trade, future growth for income today. And then there's the elephant in the room, track record. OMA is brand new, no long-term performance, no proven dividend history, just a bold pitch and a promise. Will that 15% yield hold up during a market crash? Honestly, no one knows yet. Oh, and don't forget Uncle Sam. These aren't qualified dividends. OMA's income is taxed as ordinary income. That could sting come April. So if you're buying, your best bet is holding OMA inside a Roth IRA or 401k, where those juicy monthly payouts grow tax-free. Now that we've seen both the upside and the risks, let's see how OMA stacks up against some of the biggest names in the income ETF arena. Let's throw OMA into the ring with two heavy hitters, JEPQ, the monthly paying tech ETF, and the OG himself, BRK.B. First, strategy. OMA isn't just cloning Buffett's portfolio, it's engineering it for income using covered calls. JEPQ does something similar, but with the NASDAQ 100, more tech, more growth, still using options for cash flow. BRK.B, it's a totally different game. No income, no options, just long-term buy and hold compounding. Second, dividend yield. OMA is swinging big with a targeted 15% paid monthly. JEPQ usually delivers between 8% and 11%, depending on market conditions. BRK.B? Zero. No yield. If you want income, you'll need to sell shares. Third, fees. OMA charges a 0.95%, which is high, but you're paying for active management and option execution. JEPQ comes in lower at 0.35%, pretty reasonable for a covered call strategy. BRK.B? No fees. It's just a stock. Buy it, and Buffett manages the rest. And then, taxes. Both OMA and JEPQ generate monthly income taxed as ordinary income, potentially up to 37%, depending on your bracket. BRK.B? No distributions equals no taxes, unless you sell. So here's the breakdown. OMA is the income chaser with Buffett DNA. JEPQ is the tech-tilted veteran with steady monthly payouts. BRK.B is the slow and steady compounder, great for growth, stingy on income. Which one's right for you? Let's head into the final verdict. So who's OMA really for? Simple. Retirees and near retirees looking for predictable monthly income to support their lifestyle. He's not chasing the next Tesla. He wants freedom to travel, spoil the grandkids, and still see a fresh deposit hit his account every month. That's where OMA shines. If you put $100,000 into this ETF and it delivers as promised, you're looking at $1,250 a month or $15,000 a year, enough for rent, groceries, even a vacation fund, all while staying fully invested. But let's be crystal clear. OMA is not for everyone. It's not your all-in-one solution. It's not where you dump your entire nest egg and pray for the best. Covered call income sounds great, but it comes at the cost of capped upside, and it carries serious tax baggage if held in the wrong account. So what's the smart play? Start small. Dip your toes in with maybe 5% of your total portfolio and watch how it performs. Track the monthly payouts, see if it delivers on that ambitious 15% yield, and most importantly, see how it behaves in different markets. If it holds up, then maybe it earns a bigger role in your income strategy. Because OMA might become a core part of your passive income machine, but it's not magic. It's just one tool in the toolbox. And just like that, you've got a Buffett-inspired ETF designed to drop cash into your account every single month, not just quarterly scraps. But remember, markets move fast, yields change, and strategies evolve. Stick with us, and we'll help you stay one step ahead. Still hungry for more dividend income? Tap the video on your screen now, and let's take your passive income strategy to the next level together.